Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But as we look at the different strategies utilizing options, we have to understand that some of these strategies are more risky than others, and we just need to learn how to manage for them. So to give you an example, I just did an example of a naked call option, and I utilized the CDD as an example. And we were looking at ultimately selling off 99 strike put option, expiring out to October, and we're collecting $1.20. Now, with that in mind, that's bringing us $120 in because, of course, we multiply the option contracts by 10, and one contract brings in 120. So I've only done, keep this in mind, guys, I've only done just one contract, but we can, of course, we can add to this depending on what our level of risk is. And Johnny, thanks for Johnny just mentioned online here that for September expiration, you looked at a nice trade on a vertical put on CDD, which is fantastic. So ultimately selling off some put options and capitalizing on a rally on the CDD, which is exactly why we're here today. So thanks very much for that feedback. Now, the idea that we're discussing here is just simply the rationale of selling off an option contract with the expectation that the underlying pair, in this case the CDD, is going to be above the 99 strike put on October expiration, and we will keep the premium. But what we have to recognize is that the broker is going to say, well, that's fine, we'll allow you to do this, but you're going to ultimately have to come up with a fairly significant margin in order for you to do this. Now, one thing, and a great question from Ray online, he says, why does it look at 120, which looks negative, not positive to your account? Well, we have to recognize that what we've done is we've sold something and we've collected $120. So in an effort to differentiate from a long position versus a short position, what the broker does is indicates that you are short this contract and you have collected, of course, $120. So this is the way it will actually look like. Look like in your portfolio. And DH, thanks very much for your comment there. It really shows the level of intelligence that we're dealing with here with you. But nonetheless, the idea here is that ultimately the broker is going to differentiate the position based on whether you're long or short. The important consideration is that when we're short the position and we're naked, we're going to have a particular requirement that is required by the broker, and so we're going to have to put up a sufficient amount of capital in order to do so. What we can see here is that we have a limited profit potential, but we have an unlimited risk exposure, and that unlimited risk exposure is a concern in a market environment that is extremely volatile. So we have to think about the fact that ultimately, if we're looking to sell expensive options, those options are expensive because we're in a volatile market environment, which means that there is the potential for the underlying pair value to move very significantly in one direction or the other. Now, we can look at it in the same context if we're looking at, and I have to title this to the naked call, but same consideration is that we can sell that naked call option. In this case, we're looking at selling off those 102 strike calls, collecting 70 cents per contract or $70, and the broker is also, again, requiring us to put up a significant amount of capital to meet our margin requirements. So we have, again, an unidentifiable risk exposure, but ultimately a limited profit potential. So what we want to try to do is we want to try to create a situation where we can still benefit from writing those option contracts, but ultimately we do this while we are identifying our risk exposure. So the first the consideration, of course, is looking at credit spreads, and what we need to understand is some basic concepts here. First of all, there are two types. First is the bull-put spread. So ultimately what we're looking at doing is selling put options when we think that a particular pair value is going up. And the rationale, of course, is that those put options will expire worthless as the pairs move above the written strike. Now, we also have a bear call spread, and ultimately we're selling call options when we believe that the pair value is going to go down. So we're going to benefit from collecting that premium, and then as the pair value drops down, we're going to see the options expire, and we'll be able to collect the premium. So the bull put spread, first of all, and no surprise, our outlook is going to be bullish on the particular underlying pair. We're going to sell the put option at a strike price below the current pair value, and we're going to receive a credit. We're then going to purchase a put below that sold strike, and that's going to ultimately limit the potential losses. The cost is actually subtracted from the credit received. So some people are a little discouraged by this strategy simply because the fact is that they're having to give up a little bit of the credit that they're receiving. But ultimately, by doing that, they significantly limit, number one, the capital requirement that they have to put up. But number two, if in the event that the underlying pair gets away from them very, very quickly, and as we know, these currency markets have been quite volatile over the last little while, ultimately there is an identifiable risk exposure identified right away. So the way we benefit is if the pair value stays the same or goes up, we keep the credit. So we can take a look at the CDD here, and this, of course, is the U.S. versus the Canadian. And what we would be looking at doing here is referencing a particular support level on this pair. Now, we've had some fluctuation, and of course, the market since I put this together the other day. But recognize that this 98 level is still sitting at and assuming a role as a very important strike price or a very important support level. Now, what we're looking at doing is we're looking at buying the put option down one strike lower, and we ultimately collect a premium, subtract the cost of the lower put, and our risk is actually identified as the spread minus the credit that we've received. Now, if we want to limit our risk exposure, what we're going to do is we're going to choose strike prices that are relatively close to one another, and the ISE FX Options strike intervals are actually in 50-cent intervals, so you can actually create some very, very close spreads by utilizing those 50-cent or 50-point strike intervals. In this case, we use a 1-point interval. And what that does is it still gives us a fairly significant credit, but at the same time, we have a limited risk of, in fact, 1 point minus the credit. So if we take a look at the CDD, which was trading at 99.70, we would sell 1 October 98 put, and we would collect 65 cents. So that would be sold at the bid price. We would then buy 1 October 97 put, and we would buy that at the ask price. Now, the net credit in this particular scenario here is 21 cents. Now, of course, that's $21 for one contract. Multiply that by 10, and that's $210, of course. Now, the capital requirement in this scenario that we would have to put up is the difference between the strike price, which is $1 or 1 point, minus the credit that we've received. So because no matter where the actual pair value trades, whether it's up or whether it's down, that 21 cents is ours to keep. So when we subtract the 21 cents from the $1 or 1 point spread, ultimately our capital requirement is going to be 79 cents. And again, I just encourage you to multiply this particular figure by the number of contracts that you would ultimately look at utilizing to trade your views. What we're looking at here is a profit potential of 21 cents with a risk of 79, or a return on your risk of actually 26%. Very, very attractive rate of return over a short period of time. What we can do ultimately to lower our the possibility of us being on the wrong side of the transaction is just simply moving the strike prices out. So in other words, rather than selling off those 98 strike puts, we could actually sell off the 97, or we could go down to the 96. And so if we're satisfied with even making just a healthy 10% return on capital that we've allocated, well, what we can do is we can go further out of the money with the options that we're selling, and we then have a higher probability of those options expiring worthless. And that's typically the way I like to trade these credit spreads, is I'll give up some of the profit potential for the increased probability of never having to worry about those options being in the money. Most brokers, and a question just came up, which brokers offer these ISE currency options besides Options Express. Any broker that you can actually trade options through, Wilson, will actually give you access to those particular markets. So all you have to really do is just dig a little deeper into the different products that are available. Look for the CDD, the EUI, or in fact, one of the best things to do is just take a look at the ISE site, and they'll give you a list of symbols, and then either check with technical support for the broker, or and probably the best, and again, I can't speak to that particular broker, but you can contact technical support and ask a few questions in that, as far as where you can find that. But anywhere that that you can access the options market, you'll be able to access this particular market. So what I wanted to just reference here, guys, as we move forward, is you can see that whereas the naked put writer had an unlimited profit potential, we can see here that now, limited profit potential, unlimited risk exposure. You can see that we've ultimately limited our risk to that $79 level, or the 79 cents level. Our break-even point is actually calculated by taking our written strike, subtracting the 21-cent credits, and we do not lose any money on expiration until the pair value is trading below 97.79. So we can make that adjustment. We will make some portion of our credit if the CDD is settling anywhere above 97.79 on expiration. Now, a bear call spread, of course, our outlook is bearish. We're going to sell call options at a strike price above the current pair value, and we're going to receive a credit. We're going to purchase a call above the sold strike to limit the potential losses, and ultimately the cost is then subtracted from the credit received. The pair value stays the same or drops, and we ultimately keep the credit. So I've taken a look at the YUK, which is the U.S. dollar versus the Japanese yen. And we can see here that ultimately the YUK has been in a relatively tight trade range within the last couple of months. And so the rationale might be that there's a very significant resistance level up here around 79. So what I've done is I've taken a look at my price charts. I've taken a look at some of the levels where the prices have consolidated over, or the pair values consolidated over the last little while, and I've looked to consider selling off those particular call options. What I've done, you'll notice, as instead of actually buying the 80 strike option contract, I've gone several strikes out, and I've purchased the further out of the money contract sitting up at that 82 level. Now, the reason why I might consider doing this is that I want to keep more of the credit. So the further out of the money I decide to buy the option contract, the less premium I'm going to have to pay out, so I can keep more as a credit. Now, of course, the risk is that our exposure is the spread minus the credit. So if we're widening out the spreads, we're going to be, of course, widening out our risk exposure. So that's the ultimate trade-off to consider when we're looking at implementing the strategy in this way. So at a time the YUK was sitting at 77.60, we're going to sell a 79 strike call option with a bid of 60 cents. So that's a credit into our account. With that in mind, we buy one October 82 strike call, and we're only going to have to pay out 15 cents. So we're giving out 15 cents in order to cap our risk potential at 82. That results in a net credit of 45 cents. So you can see that we've actually brought more capital. We've almost doubled the amount of capital into our account. But when we consider the actual capital requirement, we take the difference between the strike prices, which is, of course, 3 points, 82 minus 79. We then take the 44 cents, which is ours to keep, and subtract it from the 3 points, which means that we have a risk exposure of 2.56 or $2.56. So we need to come up with the difference. When we calculate profit potential of 44 cents versus a risk of 256, we can see that the return on our risk is 17%. So because we've decided to go further out with the strike price that we've purchased for protection, we actually increase our risk exposure and we lower the percentage rate of return. So we're bringing more money into our account, but our percentage rate of return on risk is less. And I just wanted to comment too, Steve made just a great point here, and on the last slides when I was talking about writing options naked, the actual titles were reversed. So anybody that's actually reviewing the presentations later on will just recognize that the naked put slide titled naked put should read naked call and vice versa. So I appreciate the heads up. Absolutely, it very much appreciated, and just a reminder to everybody who are who ultimately look to review these presentations. Now back to the risk-reward profile, you can see the difference between the bear call spread and simply the naked call is that we still have the limited profit potential, but what we've also done is we've actually limited our risk exposure as well. So no matter how volatile the actual trade, the actual underlying pair value gets, we know that the most that we can lose is the difference between the strike prices minus the credit that we've received. So what we've done is we've been able to capitalize on an expensive option contract, but we've done that with a limited and identifiable risk exposure. Of course, our break-even point is calculated by taking the 79 strike, adding that 44-cent credit, and then we have a break-even of 79.44. So what this essentially means is that we will actually make some form of profit on this particular spread as long as the pair value is trading anywhere below that 79.44 level.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.